right, man. Well, let's kick it off. Trace, thank you so much for joining me. This is my first sort of conversation for my Substack. I appreciate you jamming with me.
Yeah, this is what I love to do. I write on Substack. I did. Now I'm on Beehive. I had a podcast actually with my brother called Startup Brothers. Actually, was my brother. I got to get that back up and running. But yes, love to talk and love to write.
Well, this will be a fun jam session. I think before we dive into some of the stuff that you and I write about and think about, it'd be awesome maybe give the quick TLDR on your background, the experiences you've had, what you're doing today, so that folks have some context there.
Yep. So born and raised Long Island to two parents who are entrepreneurs. So my parents actually built and sold one of the largest tech PR agencies. So back in the 80s and 90s, even 2000s, this internet thing, when some people predicted there would only be like 12 computers in the world, my parents built an agency running PR for Sony, for IBM, these companies that were amazing at the time. I don't know the age demographic of who's listening to this, but yes, people used to buy Sony. You never got fired for buying the stock of IBM, maybe today. And so they ran all PR communications. PR at the time was you have an announcement, you talk to a journalist, somewhat like this, they write a comprehensive story, they do data, research, and they would publish it into the mainstream media, get coverage. And so that was kind of how I was brought up in the tech world. My name, Trace, I'm actually named after a supercomputer, one of my parents' clients' products in the 80s. It failed, it was ahead of its time. Technology still lives on. So I have a weird, unique name. I'm a lefty, I'm a middle child, and a Gemini. That explains everything. I went to Syracuse, majored in entrepreneurship, lived on the business floor, started my first company there called Brand Yourself, doing SEO and reputation management. I then moved to the big city, New York 2010, started working with my father, did PR for a few years, had an agency. Wanted to digitize that because the service business is difficult and the PR world has somewhat changed. So we turned that into a company called Launch It, an early product hunt, and basically wanted to be the home for all news. Pivoted, like every great company has, into the event trade show business. And CES was actually my first client. During this time, my father was investing as a professional angel. I joined him full time. That's what New York Venture Partners is. It's our kind of family holding company. We have 65 direct investments through that, all pre-seed and seed, all our capital, because we love founders. We get in early. And in the last year, I'm launching a fund as well. Because the tech world, I believe, is on the way up. Your research, our conversations on Twitter and here are showing that. And people are feeling a lot more positive about the world today. So we've been luckily early investors in companies like Pinterest, in Tommy John's, in Comixology, and a lot of others as well.
Well, it's awesome. I mean, I feel like I can feel the varied experience that you have too in the conversations that we've had. So I'm excited to get to jam. And we were talking before this about specifically one of the topics that I just wrote about this past week is venture capital unbundled. And the sort of core thesis summary there is this, at least for me, the way that I think about it is that as venture has scaled dramatically, it has become more about in the piece I called it's become more about asset management than adventure capitalism, like rolling up your sleeves and helping people build generational companies and stuff like that. And this unbundling has been people responding sort of pretty aggressively, saying that model, while it has positives and negatives, a lot of people don't want to invest in companies that way. They want to build, potentially smaller firms, more focused firms. One of the firms I talked about is a buddy of mine, Mark Goldberg, started called Chemistry Ventures, where he said that they want to out-hustle the bigger firms that have gotten distracted by scale, which, having worked in massive firms, I can tell you that scale can definitely be distracting. And so I just love watching this bifurcation because it means that there are, at the very least, I've always hesitated to say big firm equals bad, small firm equals good, because there's always pros and cons. It's nuanced. But I appreciate that there is diversity there, right? That there's a diversity of voices and perspectives and strategies and approaches, because I feel like we need more competition. If you only have big, massive capital agglomerators sucking up AUM and sucking up attention, that's the only way that companies get built. And I think that is dangerous, is that sort of unipolarity of firms. So that was the thesis of the piece. You and I have talked about it a little bit, but I'd love to get first your reaction and thoughts, and what's wrong, what's right about that perspective.
I think the word unbundling, that's just the only thing that I pushed back on. I agree totally in terms of the thesis and your magnificent writing and just the way you articulated it. and kind of responded back in the way of like telecom companies, right? They were the big companies and they got unbundled. Now you have a streaming service for every single possible right. And that is, as we were discussing, almost like niche, right? You have to own the IP. You have an expertise in certain areas and you own it. And you want to be the first to monetize it. So I want to make it clear. The big VC funds are not bad. They make money and they have historically done that. Otherwise, they wouldn't have continued to raise capital. It's just that I don't believe that our model is broken or has changed. It was 2 and 20. If that's what LPs are willing to put their money into, that's great. For LPs, it's a job. Their job is not to lose money. If they make 2x or 3x, it doesn't really change their lifestyle. A lot of these are endowments, they're institutions. So I want them to succeed. This is going to pay unions and pensions. And so in terms of funds, yes, a lot of people are leaving. It's almost like succession planning. I learned this in the corporate world. There are lifers. You stay, you have comfortability. Why would you take risk? What is the necessary driver, the incentive that says, okay, would I invest in a 3, 4, 5-time founder? They have a chip on their shoulder. They've done this before. You invested in Rippling at the growth stages. One of the greatest founders, chip on their shoulder, was able to build a massive successful company again after Zenefits. You go to Rippling. Truly impressive. If I had the opportunity, maybe I would have invested in them as well. But to your point about the smaller funds being more nimble, they have to be. It's kind of like startups versus enterprises. These companies aren't going anywhere. Facebook, Google, Amazon, sure, people are coming after them and death by 1,000 cuts, but they print money. The last 2 years is really what has caused, as you said, this bifurcation. Totally agree with that. The haves and the have-nots. When money dries up, people flock to safety. I've written about it. Your research and your writing as well has shown, yes, emerging managers fund formation has dropped almost 50%. Josh at Lux predicted this. It was somewhat of an easy prediction just because way too many people raised money in 2020 and 2021. When everything was awesome, everything went up and to the right. Venture capital and startups are not supposed to be easy.
Yeah, I agree with that. I think that something that I saw today is this increasing point of like the hollowing out of the middle, where I think that folks are especially like allocators across the board, whether that is larger firms or small family offices or whatever, they're focusing more on either these big established firms or these like smaller bespoke sort of specialized focus or background or category or whatever. It's sort of this middle ground where you're a $500, $600, $700 million fund. You're big enough that you need to sort of take swings at some of these really competitive deals, but you're not so small that you can have this like outside outcomes. So I feel like that hollowing out of the middle is what's happening. Do you think that's true, that you can't exist? Like, what's the strategy if you were to try? Let's say fast forward 5-10 years, you've created this firm and it's very successful. You've raised multiple funds, and now the question is, okay, do you swing for the massive sort of plays of raising multi-billion-dollar funds, or do you maintain this very disciplined strategy of a firm? Like how would you avoid building in that middle?
It's that kind of middle ground where it's a barbell. You're either the massive firm and you have the unfair advantage, or you're a small, nimble, and you try and get in early. So this will be a time machine. I will look back on this in many, many years and say, I want to grow AUM. I have to raise multiple funds. That's kind of the definition somewhat of success, that continually LPs bet on you. Hopefully you get up rounds, but you also don't get liquidity for multiple years. It's definitely a very long game. That middle ground is interesting because if you're raising over $100 million fund, if you invest $1 million, like that is 1% of your fund. It's not really meaningful to you. So you then have to start playing in the 5 on 25s, which, as we found historically, is one of the worst rounds. Why? The multi-billion-dollar funds, that was a lotto ticket for them. That's their unfair advantage that we all wish we had. Yes, of course, I want to raise hundreds of millions of dollars, billions of dollars. We'll see where the market goes, where the exits continue. But if I can't work with founders day to day and like have all these testimonials that I have, like it kind of loses what the soul of the business is. And I almost thought about shaving before this, but I want to show like you earn your gray hair with a lot of these founders. So it's a lot of fun. That's
Yeah.
just why we do the early stages.
Well, and I think that like I guess like I push back on the conclusion because I feel like the so in the piece I mentioned this idea that I've written about this a few times that we venture capital as a discipline does not necessarily evolve in the way that you think it should, or even like when you think about the returns math, right? Samir and Allocate made this point that people have sort of used this bucket of like big firm, small firm, but in reality there are a lot of sort of isolated strategies that generate very specific economic products. And
Yep.
you have a specific risk appetite required to feel comfortable with them. They're going to give you a specific return threshold, whatever. So there's actually like a lot of different buckets of good,
Yes.
bad, ugly, and I feel like that venture has evolved in this direction of capital agglomerators, not because it's necessarily the best model, whether it's not necessarily the best model for driving returns or like building good businesses. I don't know that that's true, but it's definitely the loudest and the biggest, and they have the budgets to be louder and be bigger, and so it kind of pulls people's attention. And so I feel like when you talk to a lot of managers, what they like, whether they're honest about it or not, because LPs certainly pressure GPs when they invest in small funds. They don't want scope creep in these funds, so they kind of like to put a little bit of pressure on firms to stay small, to stay dedicated. But
Yep.
for the majority of GPs out there, I think that the natural inclination is, well, I just want to have as large of a fund as I possibly can. And when you look at the like philosophies of the Andreessens and General Catalysts of the world, and the philosophies of the benchmarks and USVs, the benchmarks and USVs are getting drowned out by how loud and how big and how aggressive and how much weight you can throw around when you're big. And I think that the problem there is that because you go back to like, okay, if you're just about returns, like, are we generating money? Like, I think that the data is pretty conclusive that you're going to get worse returns generally. I have another conversation with an anonymous Twitter account, a guy that doesn't want to go publicly, that I think will be a little spicy on this because he kind of
Yeah.
disagrees on this data if it's as conclusive versus just volatile. But I think like overall it makes sense that like if you're deploying $1 billion, it's dramatically harder to 5x $1 billion than $100 million or $30 million or whatever. So I think that sort of law of large numbers generally
Yes.
is true. And so you're going to get worse returns, but that's okay for LPs that, to your point, that want to shill out 100, 200, $300 million checks a pop.
Yep.
Their yield, I've called them in my piece on the unholy trinity of venture capital, I called them yield farmers, right?
Yeah.
And that's like they're okay with those buckets. But my fear is that like it's just natural to say, yeah, it's just a matter of success. Either like you should just want to be as big as you possibly can. Maybe you won't be good enough to be, managing tens of billions of dollars, but that's the aspiration. And my argument is that I feel like that shouldn't be the aspiration, because that means that every company gets built to be the biggest business it possibly can be, to burn as much cash as it possibly can be, and to be as multifaceted and complex and sort of risky and platform focused as it can. Which for some businesses that's great, but
Yep.
I don't think that's true of every business. But the danger is that loud models of funding, venture capital, pull everybody, managers, companies, LPs, everybody goes in that direction of we should be as big as possible, investing in things that can be as big as possible. That's where I feel like there is kind of a danger, Will Robinson, in my head.
Totally agree. Danger Will Robinson. But LPs invest in it, which kind of perpetuates it. When there's no liquidity, they flock to safety, which is what we're seeing right now, where you saw the data. Dan Gray writes about it very eloquently as well. We know in 2024 went to 30 firms. Almost 50 of that, 50% went to about 3 or 4 firms, right? The Andreessens and Sequoias. And that is just AI, right? Without AI, we would have had probably the worst year in almost 2 or 3 decades. That's what I was discussing with people. But we had it. We had AI, and that kind of saved us. And so people are throwing money at it, and that's fine. I got pushed back on my newsletter a month or so ago is big VC just the same as private equity now.
Yeah, I like that piece a lot.
Yeah, and so some people reached out and was like, please, like, stop. Because once you go from PE to VC or vice versa, the LP mindset behaviorally changes because they see different types of assets, different return profiles, and different time of returning capital as well. As you said, they're yield farmers. VC is a subset of private equity when we look at all of these data points. Sometimes it's not even broken out because it's so small. But as you said, these VCs raise from institutions and pensions, endowments, and sovereign wealth funds where they can't write less than $100 million check. Some of them can't write less than $500 million because it doesn't move the needle for them. So a problem someday I wish to have. But they have to deploy it. And if they could put $100 million in Sequoia or put $10 million in 10 emerging managers, 9 out of 10 times it seems like they'll just write $100 million check. It's easier, it's safer, they won't get fired because it's less risky. Could they return technically, statistically more money? Probably, if they chose right. But then they have to do more. Right, if they chose right. But then again, we have all these firms who come out of nowhere, and it's a hit business. And I always love it. It's like, haha, I knew it. See, I told you 10 years ago when I made that investment. You all thought I was crazy, but it worked. And so that's kind of the business we're in, where, as you said, the fund strategy, where if you're a small fund, right, that kind of scout fund, the 1 to 10, sometimes 20 million, writing 50 to 250K checks. I'm an LP in 3 of them. And they were writing 35 to 50 checks because it's a scout fund. The understanding is that it might not make a lot of money, but can they prove that they can get into businesses? There's FOMO from a LP standpoint, at least at the emerging managers, the big LPs. I talk to them, I get data, you got to build relationships, rapport, it takes years. So without high net worth, without family offices, just rich people in general who like this tech stuff, there is no early stage investing.
Yeah. I guess like the question is it a, like, rather than the LP who can invest $100 million and they can do $10 million checks into a bunch of small funds, or $100 million checks into a big fund and just farm the yield there, not really worry about the downside or whatever.
Right.
But for the LPs who get sucked into the attention, the loudness economy, right? Of like, they could, maybe it's a couple $100 million family office who 10 million is their total allocation to venture, and they want to put it in, one fund, and they can put that $10 million into a small fund, a $150 million early stage focused fund, whatever, or into a $3 billion Andreessen fund. Like, based on the data, they would probably be better off putting that into a smaller fund, assuming that they're doing a good job of manager selection and judging for access and brand and stuff like that.
Yes.
But they get sucked up into the attention of, well, Andreessen is so good, I should put it in this massive fund, because it totally is the IBM effect that you were describing earlier of like, nobody gets fired for putting it into the big massive thing, even if we don't actually make that much money on it. Is that bad or is that good?
I don't know yet. The verdict is still out because the industry is still growing. The last 2 years, we'll see how people survive. But I'm having these conversations in all these like LP family office group chats that I'm in, where people are saying, oh, these are great funds. Look, you've come up. People love your research. They love your background. You've made great investments. So like, you have a great reputation as well. And I believe, right, you had $20 million, $75 million fund. You're in Anduril, you're in Ramp. You've made these great investments. Hey, look, we're co-investors. I put a small check into Series B SPV into Anduril, right? So like, awesome. I'm going to put it on my LinkedIn. But what we're seeing now is that big question. Is money the incentive for these family offices? As you said, if they're worth a few $100 million, they then allocate $10 million. The average time used to be, 8 years. With the last 2 years, especially now, it's closer 10 to 12 years of illiquid lockup. Great. Your family business probably made another few $100 million. If I can return you $30 million, right, the 5% that can get 3x DPI net fees in 10 years, you probably forgot about it, right? So it's really interesting that for family offices, it's not so much a financial incentive. I have found some of them are, depending on what their backgrounds are. If they're second or third generation, they could be in the tech world. A lot of them are just doing late stage SPVs. We always ask founders, what business are you actually in? Investors, what business are we actually in? People think we're in the investing business. We're actually in the business of exits. Our world does not exist, and why it's been difficult the last few years is because there have been no exits. The far and few between ones, some have been stopped, great. Gary, Lena, you can blame whoever you want, monopolies. Some of them should have gone through and some of them should have been blocked, right? Like Adobe and Figma. Would that have been a monopoly? A $150 billion company paying $20 billion? Some people say yes, but that would have created a huge windfall. When things are going great and there's liquidity, it kind of gets recycled. But now that LPs are over allocated, we are having issues. And I would love your kind of thoughts on this, on secondaries, on continuation funds.
I think this is a really good topic to to finish up on, because I think this is sort of like, you think about the future of where stuff is going, and to your point, like exits and liquidity, sort of that's where the rubber hits the road. Like we can build as much sort of exciting future potential and dream the dream as we want to, but if that doesn't actually become something long term, that there's a negative to that. So two thoughts that I have: one sort of more short term macro, one is sort of long term existential maybe. So in the more short term, because I have seen this, right, like the secondaries market is really picking up in a massive way.
You got SpaceX shares? I need some SpaceX. You got any?
Yeah, exactly. It's a ton of stuff like that, and you even see, like, I think it was, who was it, like the maybe head of Goldman Sachs investment banking or something. Somebody was talking about, like, it's like, yeah, you question even the reason why a lot of these companies, like, what motive do they have to go public, right? What's the sort of benefit? Because I think even, like, I haven't run the data, thought about it, but the only real sort of venture-backed tech IPO we've seen recently is Service Titan. And I know that they've said that, like, the sort of ratchet that they had was not, that wasn't they say that wasn't the driver, but like it feels like economically unpack that, and it feels like that's a very logical reason to go public, right? It's like if you sort of, debt is coming up, like you pay it because you don't want to suffer the consequences. Like ratchet is the same. So haven't been a lot. So like, what is the motive for going public? And it's like, yeah, like when you have so much demand for this stock and there's sort of so much downstream capital, and people can see like, hey, these can be generational businesses that can stay private for a really long time into the 60, 70, $100 billion valuations. It's like, why go public? I actually do think that's healthy, because I think at the end of the day, it's a question of, like, Peter Thiel has this line where he says, any competitive round is by definition underpriced, right? Where if Databricks, right, Ali said this, where they went out to raise 2 or 3 billion, and by the time they had finished sort of calculating everybody's demand, it was $20 billion of demand. And so they raised 10 billion, right? They didn't raise 20, but they raised 10. But but if he had 20 billion of demand and they raised 10 billion, that's 10 billion of demand he didn't raise, which means if basic economics, if he had just kept raising the price, he would have eventually come down to that 10 billion, because people would have fallen out at some crazy price. But that end price would have been bananas, right? You have to leave money on the table. You don't want a fully maximized price, because that fully maximized price is not at all going to represent the economic reality of the business. It's going to represent the hype reality of the people around the table or whatever, right?
Yep.
And so, like, I think that if the only thing I'm conscious of is the fact that so much of that secondary demand is driven by like hype and the sort of like peak bubble mania. That's the fear, is that you're then just sort of trading, illiquid for illiquid, but like that downstream capital still happens. It's just that you have capital destruction happening in private. And I actually think that capital destruction happening in public is really important, because if people get wiped out and you don't really know that much about it, it doesn't have the same sort of cautionary tale learnings for the broader ecosystem. When you see, the perfect example of this is WeWork going public, right? Like WeWork didn't do anything illegal. They just opened up the kimono, and everybody was like, this is awful. And it just everything. Like, that's healthy. Like you want to shine light on these sort of, behaviors and building methodologies and stuff like that. So my only fear with it, I think it's good because it does to your point, like increase, it sort of it greases the wheels on, yeah, adding liquidity to the ecosystem. The only danger is that it keeps there's and arguably, like, it's not even that like people do diligence in these big, rounds, and then just keep stuff hidden. It's that they don't do diligence, you don't find out, you don't do a ton of diligence, right?
You can't. They don't
Yeah,
give you
totally.
anything. My friend bought
Yeah,
SpaceX at 80 billion, sold at 250. Knew nothing about the company.
totally. So you just don't know. That's one danger. I think, though, existentially, longer term, my primary fear is, and I wrote about this a couple months ago, is this idea that venture capital as a business has largely, and arguably it never had like firm economic plantings, but largely as a business, it has become divorced from the overall outcome of the business, and instead is focused on the incidental outcome of the business, right? And so it sort of increasingly has started to look very similar to the sort of crypto pump and dump, where it's like, I don't care about the long term outcome of this business. I care about the business from my entry point to my exit point. And a good example of this is like, so Peloton, it's really like, Peloton is a very interesting business fundamentally,
Yes.
but it's always this idea of like any deal or any investment or whatever can be good or bad depending on the price, effectively, right? And I think Peloton is a good reflection of that. It's like, it's a good business. It's not a 60 billion or 120 billion dollar business or whatever, right? Like, at least in its current state, maybe it could have evolved to that. But
Yes.
you have John Foley, who builds Peloton. He's a great entrepreneur, builds a really interesting business. There's a content component to it that's really fascinating. There's a brand that's like worth writing textbooks about. There's a hardware component, but the overall economics of the business, they just don't scale the way that sort of price expectation requires.
Yep.
But then John Foley leaves, and he starts. I think I wrote about this maybe like a year ago. He starts it's like a luxury D2C carpet brand or something like that. And it's like what? And he raises like a $20 million Series A right out of the bat. And you're like, why do his investors do that? Like, Peloton has crumbled. And it's like, right, but his investors are not focused on the overall outcome of Peloton. They are focused on, I entered here and I exited here, and so John Foley made me an ungodly amount of money. I'm going to back him again. And that I think is not great. Like, I think that we should care about the actual ultimate outcome of these businesses that we're building, not the incidental outcomes. And I can't remember who it was, but there was a senior guy at General Catalyst who had talked about, he joined Google, I think, in like, I don't know, 2005 or 2006 or something. And he's never sold a share of Google. Like all the stock that he got, all the equity, he's bought more of it. Like, he believes in the long-term eventual outcome of Google, as opposed to this incidental entry price, exit price math.
Yep.
And I like that. I recognize that funds have life cycles and they have end dates and they need to exit at some point and stuff. And I believe that. And I like the like general philosophy of Sequoia's evergreen vehicle, of like recognizing that like they would have made a lot. Like, I think I posted, somebody recently said, today, if you had gotten in at Shopify's IPO to
Would have
today,
done better.
yeah, then their seed round,
Yes.
right? Like this value creation from seed round to IPO wasn't as good as from IPO to today. And it's like, I love that. Like, that's sick. Like, let's build more businesses that have those generational returns in the public markets. I want more of that. I don't know if Sequoia's executed their evergreen strategy super well, but that philosophy of like believing in long-term outcomes, I think we don't have very much of in the way that venture is structured today.
Lots to unpack there. So let me start at the end with what's most recent. So in terms of John Foley and Peloton, these are these are ZERP era companies where I think, I'm just looking here, like they IPO'd at 25. So great. They IPO'd at probably around like 8 to 10 billion. Were they worth that? Okay, it was a little hyped. It was a great company, revenue, everything was growing, but retail investors made it a massive, huge speculation. And it's a hardware company really at the end of the day. So they had scaling issues. And everything else during COVID, ZERP, I will always discuss it, went up and then came down. We literally pulled years of demand forward. If you look at all the growth, most companies should not be growing hundreds of percent year over year. I wrote about it months ago about why companies are not going public, because you need about, on average, about $500 million in ARR to go public and growing about 30% year over year. That is the expectation in terms of most companies. To your point, Service Titan, they had their ratchets, and people were doing the math. When they first priced it, it was at like 60 or 70. Then it went up to 70 or 80, and then like 90. So in terms of the ratchets and dilutions, because it started in May after like 2 years, they got diluted on the common shares by like 3 or 5%. So at the valuation, it came out to like $150 million. It's trading at like 97 now. It IPO'd at like 100. So they're doing fine. We've had, 4 IPOs, I think, in the last year, truly. Reddit, it's at $180. If you bought it at like 45, you're up almost 180, 190%. Klaviyo, Instacart. IPOs have actually done relatively well. And so in the olden days, the graybeard, people would IPO because it was another fundraising event. There weren't these massive funds, which more or less started thanks to SoftBank in 2017 when they raised $100 billion. Masa said, all right, everybody, I'm just going to change the game. I'm raising $100 billion. You want to go raise a series A, B, C, D, and then go public? Fine. I'll give you E, F, J, K, L, M, N, O, P, right? So you didn't have to go public.
Yeah, I think that's super interesting. Well, listen, man, this is awesome fodder to keep the conversation going. I appreciate you jamming with me and looking forward to your writing. I know you mentioned you got some writing coming up. We're just reacting to some of my stuff, so
yeah,
I'll make sure to link all of this stuff as it comes out. But really appreciate you having the conversation.
Yeah, this is fun. I love when Twitter actually works and we can have good discussions and banter and go back and forth and actually be civilized humans.
That's right, man. It was good to see you.
Awesome.